Kenneth Pulcari, Chief Market Strategist at Slatestone Wealth, with us this morning. Kenneth, very good morning to you and great to have you with us here on NDTV Profit. What are the cues that you are seeing from the Fed, and does any of it matter if there's going to be a new Fed chair coming in with perhaps a very different agenda?
Well, the new Fed chair is not coming in until May, right? Because that's when Jay Powell's current term ends. And so I'm not really worried about it right now. I do think the new Fed chair is going to be a Trump pick. He's going to be a Trump loyalist. He's going to want to lean towards rate cuts. But I got to be honest with you. I'm not sure that, the data is suggesting that we need to cut rates anymore. I know there's 3 or 4 members currently that are already in the neutral camp, like, okay, we're right where neutral should be. So unless the data starts to really fall off the edge, they're going to vote not to do anything, at least January and March. When May comes and we have a new Fed chair, that's going to be a different story. The data may be different, and the data may actually be stronger, right? So you don't know yet. It's too far out. But I'm not necessarily really worried right now. I think Jay Powell did a great job in terms of, he made the cut, but he was a little bit hawkish, but he wasn't so hawkish to send the market to a tailspin. He made very positive comments about the economy. He made positive comments about while the labor market is softening, it's not falling off the edge. And while tariffs did not create the hysteria that everybody thought it was going to create. And while inflation may tick slightly higher, he sees that we're near the top and it's probably going to start to retreat. So that was all positive news.
Kenneth, morning from where we're at. Alex here. I'm just wondering, from your lens, how far can you see out? And if you were to pencil in where you expect policy rates to culminate and how much the cut will be from this point on, where would that be? What are the implications for risk assets?
So listen, I didn't think they should have made this cut. I was happy with what we were a month ago, right? With that cut. I was not in the camp that the Fed should have even made this cut. So now I accept the fact that they did it, but now I'm in the camp that that we stay right where we are. I don't see a reason for another rate cut based on the data and the data that we're seeing. The way the economy is expected to grow in 2026, S&P earnings are expected to be up double digits, 13 to 15%. GDP is expected to be up a little bit better than 2%. Those are all solid numbers, and Jay Powell referenced that today in his speech. So as far as I'm concerned, I think rates are very good where they are. I'm actually thinking they're on the low side. They're no longer restrictive at all. And while some on the Fed think we're at neutral, I think we're a little bit below neutral. So if you ask me, and I'm not a voting member, I would have voted to stand still.
Well, Kenneth, it would be interesting to see if there are more voting members out there in the Fed and the quantum of dissents that could be. But I wonder what you made of the Treasury buying that has or will start or has started since December. What impact can that have, considering that what a lot of people said that maybe the Japanese central banking meeting is the more important one versus the Fed for the month of December?
Well, it might be. I think that was a little bit of a surprise, the announcement that we're going to start to buy short-term bills, not the longer-term bonds that we were buying during the great financial crisis, but short-term bills to kind of keep the liquidity in the system and try to pin, the Fed funds rate right where they wanted it, 3.5 to 3.75. So,
okay, I think I've lost your audio, Kenneth.
I think it's gone on mute.
Yeah, but I wonder if it suddenly went on mute. It just suddenly popped off.
Yeah.
But that's the interesting piece, right, guys? The surprise out there is not the 25 basis point cut, but the $40 billion monthly buying. Okay, I'm told Kenneth is back, but just before you go to Kenneth, I don't know what you guys thought of it. 40 billion every month, short-term treasuries, quite an interesting, surprising move.
So you look at it in multiple ways. In a sense, what Kenneth was just pointing out with regard to liquidity, right? So ultimately what central banks do through these activities would be essentially to manage liquidity. Our own central bank does open market operations where it buys effectively Treasury, and it pumps liquidity into the system. And you're controlling what the rates are at the short end.
I think we have to also look at it in the context that no one knows, including the Federal Reserve, what is the final impact of tariffs. on inflation. It's spiking in some places, it's not. Okay, Kenneth Pulcari back. Kenneth, I hope we can hear you, because I think you could hear us, but we couldn't. So,
Yeah. Can you hear me now?
We can. If you just want to finish that point.
So I was going to say, that was the surprise, the announcement that they were going to start doing that. But to the point is, they are short-term bills, not the long-term bonds. It's going to try to create and continue to add liquidity to the system. And now that we're going to let the rates and the market kind of settle in, see where this goes. So while I was surprised by the announcement, I don't necessarily think it's the worst thing in the world. So I'm okay with that. Let's see where it goes.
A view on emerging markets, Kenneth, and India. While we're here, India has had a particularly rough year compared to other emerging markets as well. A lot of commentary on how that could be turning. Wondering how you see it.
Listen, I'm not a specialist in emerging markets. We do have emerging market exposure, but we do that through ETFs. So I'm probably not the right person to ask you. I will say that most of our portfolios, while I personally don't, most of our portfolios always have an emerging market component to it, but it's done through an ETF. So it's not necessarily country specific where we're going in and buying individual names in that country. We do it through the ETF. So I'm not necessarily probably the right person, because I'm not a specialist in that in the emerging markets.
Fair enough. Kenneth, thanks so much for joining us this morning, though. Pleasure speaking with you as always.
Thank you very much. Bye-bye.